in other words, the mortgage was kind of coming due. And is a
balloon,
one of those
probably.
balloon mortgages. Yeah. It was coming due. And if he didn't have another buyer quickly, he's going to lose the building. So now we have a very motivated seller. A little different than 6 months ago, right? So we went back and forth. It still wasn't worth 3.9, regardless of the fact. I think we settled on 3.3 and ended up appraising for 3.9, which was great because there's already built in kind of equity. But he was motivated, right? So I always say to people, and I think there's a lesson there in that you have to be willing to walk away. You can't just, be so excited about a project and in love with it that you're going to make a wrong financial decision. If you've underwritten the deal, you've done your financial analysis, don't be afraid to walk away, because if it's the right deal, and it's the right project, things will happen. And that was a perfect example. We walked away. We said, we can't make it work for your number. There's no way. Right. And we raise money from investors, right? So we need to make sure we have the right finances in place so that we can get our investors the returns, right?
Welcome to Real Estate Deal Closers with Anette, Talie, where we focus on the deals. Our guests are real estate closers who will share in detail the whole process from finding a deal to closing it, as well as strategies and tips to help you do the same. Here's your host, Anette, Talie.
Welcome to another episode of Real Estate Deal Closers. I am your host, Anette, Talie, and my guest today is Liz Faircloth. Welcome, Liz.
Thank you so much, Anette, for having me on your show. It's a pleasure to be here.
I am super excited to have you. I had your partner on my podcast before, so I'm very excited to have you today. So, guys, let me tell you a little bit about Liz. She co-founded the Rosa Group in 2005 with her husband, Matt. The Rosa Group, based in Trenton, New Jersey, is an owner of commercial and real and residential property with a mission to transform lives through real estate. The Rosa has vast experience in bringing properties to their highest and best use, which includes repositioning single-family homes, multifamily, apartment buildings, mixed-use, retail, and office space. The company controls close to 700 units of residential and commercial assets throughout the East Coast. Liz is the co-founder of the Real Estate Investor community, a platform to empower women to live financially free and balanced lives through over 25 meetups across the US and Canada, and an online community and membership that offers accountability and mentorship for women to take their business to the next level. She is the co-host of the Real Estate Investor Show, a podcast providing straight talk strategies along with inspiration for successful women who share their journey. Awesome, Liz. Thank you for being here.
Absolutely.
So I would love for you to tell us, how did you get into real estate?
Sure. So, I wish there's just this glorious story that most of us have, like the lightning bulb comes down to do it, invest in real estate. But it didn't quite happen like that. With my husband and I met him and, we were, I was on track to work very hard. I was about to get into a consulting job. I was right out of graduate school. I was in my early 20s, and I met my husband, who was working very hard at a engineering company. And, I read Rich Dad, Poor Dad. We both came from very strong middle-class families where you work very hard, in a job and that's just the traditional path, so to speak. And reading that book opened my eyes to just so many different concepts, right? Just the idea of passive income. Oh, wow, you can build something that earns you money versus you having to work for it, right? And it's just this whole paradigm shift, especially in my 20s. I was still young, to kind of like, I can take this path or we can start building towards a new path. And, at that time we took a bunch of courses. It was like, let's do this. We didn't really have much money. We didn't have any experience. We were in our 20s, so no one really took us seriously, but we said, let's do it. Let's at least take some courses, learn what we can, and take the plunge, because we knew that was kind of the path we wanted to take, even a small way, in a step-by-step way. So we took a bunch of courses in local RIA group for about a year, and finally took the plunge and said, okay, let's make some offers. And we offered we actually found it by calling for rent ads at the time in the newspaper. I know I feel like I'm a dinosaur here. I'm like 95 years old, but that was like pre-internet really, the internet may have been sort of getting going, but in terms of where we are now, it was like totally night and day. So for rent ads, and we found a buyer, we found someone a seller who was looking to sell his duplex. So our first investment was a duplex right outside of Philadelphia. And we got the down payment from my father. He loaned us the money, $30,000, and kind of scraped together the money to renovate. And we held it for about a year or so, and then we ended up moving to New Jersey and really starting our investing career there. We kind of held that property for a short time, but did like a 1031 into that and kind of advanced there. But yeah, that was our first project. It took us about a year to study and to feel comfortable, and then take the plunge into making it happen. So
that's so funny. We have a lot of parallels. It took us a year to find our first property, and we bought a duplex.
Okay.
Were you looking for a multifamily, or it's just what you happen to find?
Yeah, I don't know if we were that strategic in a lot of ways when we started, but yeah, we were just looking for an opportunity. Yeah.
Mm-hmm.
And, the area that we were looking in just so happened to be, right outside of Philadelphia, older homes, highly densely populated. So by nature, you're going to find more smaller multis, which was this little community was full of. Really, to find a single family would have been harder to find unless you found it was more like row homes. It was actually an attached home on both sides.
Right.
So you're going to find a lot more of those small multis in that area. But yeah, it wasn't really a strategic move by any means, but more so what was up, what was in our backyard.
Right. And when you started, were you planning to do flips, buy and hold, or you just rentals? What was your plan?
Yeah, I wish we had a little more of a strategic plan. I will say that, but hey, you live and learn. 15 years later, you get a little smarter in some ways. When we started, we got involved with a lot of different things. So we bought that duplex, and then we started flipping, and then we bought like raw land. We bought a commercial. We just got into a lot of different things very quickly. I don't ever suggest that to people. I think it dilutes you. You're not able to get good at something, and really become masterful at it, right? You can't do a bunch of different things, become masterful at any of it. So I think that kind of took us a little longer to get to get going. And multifamily was really the focus for us all the time. And then we really went all in when we got a little more focus and woke up a little bit and said, okay, let's focus. And, where we really strongly went in on multifamily. And that's most of our portfolio right now is multifamily. But yeah, we did some flips and we kind of dabbled in a lot of different areas until we really said, okay, let's really focus on this area and make this our business model.
Awesome. When we got the duplex, we were looking for multifamily because we just wanted to have the liability. If one apartment was empty, we still had the income from the other one.
Yeah.
And that
absolutely.
was like our whole point, because we wanted to make sure that we were not depending on just one income stream. And that was the whole point for us to get into real estate. So even with the investment, we were like, okay, we cannot afford a 4-unit, but we can buy a duplex. At least that's 50-50, right?
Yeah.
So that's awesome.
The Deal.
All right. So what type of deal are we going to talk about today? What type of asset was it, and where was it located?
Sure. So like I mentioned a moment ago, we really got our kind of our start in multifamily, and we slowly grew. So we were a duplex, and then we bought some fourplexes, and we were at a point in our career, it was just about 5 years ago, and we were buying kind of small multis, 10-unit, and then we went to an 18-unit. We grew very steadily like that. We didn't go from like a duplex to a 200-unit apartment building. We really just grew very steadily. So at the point of, we had the largest asset to date was an 18-unit. We had about 200 units under our belt. And we got presented with a deal, a 49-unit, and it was located right outside of Lancaster, Pennsylvania. So we had always had the rule that we only invest locally, 30 minutes within our radius, because we were managing everything ourselves. We were leasing everything ourselves and our team. So the thought of going any further was a lot, right? Because you just want to be close to your assets. So this is the first property that kind of got us moving forward in terms of like finding a property management company if we had gotten in, and a whole new world of moving from self-management to kind of outsourcing that management piece. So anyway, long story short, it's a 49 unit, and we had already closed a couple deals with another commercial broker. So when this opportunity came up, it was his listing. He gave us a call and said, hey, because, once you start to build those relationships with those commercial brokers, they know you can close, they start to look for you versus you looking for them, which is a good thing. But you got to close the deals. You got to do what you say you're going to do. And, you got to show up. And I think that's the biggest frustration, right? That commercial brokers have with people. They say they want to buy these things and then they just can't put it together. Right. So you gotta be able to put these projects together. It would be my one recommendation to folks. So we found this deal, and the asking price was 3.9 million. 3.9. And the buyer, had owned it for about 25 years. It was basically a converted factory, which is very big in Pennsylvania. You'll find a lot of older properties getting converted to more loft style. It's a very, at least in this area, was a very popular kind of approach. But the gentleman was at a point where he's retiring. He wanted to move on, and that was his asking price. So we had underwrote it and did we did the financial analysis, and it really was worth somewhere between 3.2 and 3.4 was really what the number was. So we offered, I think we offered 3.2, and he laughed. The broker said, listen, I love you guys, but I'm even embarrassed to bring this to my seller, but I will, because I know you guys can close, and I know you're good, you're good operators. So he did. And the seller said, no way, I'll get my price. So they went away for about 6 months, and about 6 months, got another call from the commercial broker and said, that project you're looking at, the buyer fell through for the project, and the seller, his mortgage is in other words, the mortgage was kind of coming due, and is a balloon, one of those balloon mortgages. Yeah, mm-hmm. It was coming due, and if he didn't have another buyer quickly, he's going to lose the building. So now we have a very motivated seller, a little different than 6 months ago, right? So we went back and forth. It still wasn't worth 3.9, regardless of the fact. I think we settled on 3.3, and ended up appraising for 3.9, which was great, because there's already built in kind of equity. But he was motivated, right? So I always say to people, and I think there's a lesson there in that you have to be willing to walk away. You can't just be so excited about a project and in love with it that you're going to make a wrong financial decision. If you've underwritten the deal, you've done your financial analysis, don't be afraid to walk away, because if it's the right deal, and it's the right project, things will happen. And that was a perfect example. We walked away. We said, we can't make it work for your number. There's no way. Right. And we raise money from investors, right? So we need to make sure we have the right finances in place so that we can get our investors the returns, right? That everyone knows that. It doesn't, oh yeah, I'll offer anything. You don't want to put the building obviously in the wrong financial hands and position. So right. That's the deal.
So let me back up a little bit. So you mentioned that how you found the deal was through a relationship with your broker. So how did you build this relationship with the brokers? Because I think that's one of the things that a lot of people are afraid to reach out to brokers. Yeah. So how did this relationship start, and how did you keep this relationship going?
It's a great question. So we met this broker. So we were looking to expand from New Jersey to Philadelphia, and we were looking at an 18 unit, and he had this listing. He had the listing for an 18 unit. So we met this particular broker on that project, and really was cultivating the relationship. I think we found it online and reached out to them proactively. They didn't know us. We proactively reached out to them. And again, brokers they're assessing you. They are like, are these people for real? Number one. Mm-hmm. Number two, do they have the money behind them to say they're going to close? You might want to buy multifamily, but it doesn't mean you're actually going to be able to do it. And three, especially in that time of the market, it was a hot market. So everyone wanted to buy multifamily. Mm-hmm. So what is going to set you apart? And so we reached out to this broker and really just started cultivating the relationship. We also, you have to tell them up front what your track record is, not to be boastful, because I'm not a big fan of that, but to brokers, you need to tell them what you've done, the successes you've had or the deals you've closed. so they know who they're dealing with. And I think it was a face-to-face. We met with them in person. We had a really good meeting. We talked about what we were looking to do, our business plan, like, this is our first full-time job, and you don't have to have be a full-time investor to be effective, but they have to take you seriously. So I think that's the number one tip. And whatever that looks like, and I got to tell you, follow through. I was in sales. My husband was in sales. I'm very nice. I'm very tenacious. So if we, and that's the key, right? You can't follow up once with people. If you want something, you have to do what most people don't do. They call these commercial brokers, they reach out, they do what everyone else does. Oh, I want a deal. Send me your deals. Send me your deals. They never hear from the broker. And then they wonder why they're not getting any deals. Well, let's think about doing something differently. Maybe sending them a handwritten card. Thank you so much for meeting with me. Learning about them, right? Are they into golf? Are they into sports? Are they into whatever? On that first conversation, learn something about them, and then send them an article in a few weeks. Hey, I was thinking about you. You said something about this. I was thinking about you. Like, people don't do that kind of stuff. And I feel like you're trying to build a relationship with anyone. Like, I just think you have to stand apart. How can I stand apart to these brokers? Beyond the money, beyond the fact that I'm going to close, beyond all those things. Do I have a track record? How can I build one as quickly as I can or partner with somebody? And number two, how do I really help them, and serve them in some way? And that I think we did naturally because of who we were. I mean, we do a lot of things not right. I mean, there's a lot of mistakes we make, but that was something we both, I think, that's a strength of ours, right? We have strengths and we have lots of weaknesses. Right. But set yourself apart and follow through, and then have a way to follow up with these people. Maybe they're on your social media, or they're on a newsletter list, or whatever way they can stay. People are going to forget you if you're not in front of them. Like you think everyone wakes up thinking, oh, they're going to think about Liz Faircloth and the deals that she wants. No, we all are in our own little world, right? No one does that. Everyone's got a lot going on, especially now with the world we're in. So you got to stand apart even more and have a way to follow up with people that are important to you, especially those brokers. How's it going? Is there any way I can help you? Most brokers don't get questions like that.
Right. So once you had that relationship, then he found something and he brought it directly to you, right?
That's right.
So that's how building these relationships work, because he knew that you were going to close. You had already closed with him on the 18 unit.
Yep.
Right. So
that's right.
They brought it to you. Awesome. All right. So how did you negotiate this? I know he wanted 3.9 and you were at 3.2 or 3.3 when you close, but what were the negotiating points that you pointed out to the owner so that he would accept your offer when you offer low?
Well, the first time he was like, this is ridiculous, and laughed, right? Because he wasn't motivated. When we went back and said, hey, this is where we're at, he was motivated. And that's what the broker told us when he called us back those 6 months later, saying, I think we're going to be a lot closer, and so when we met together, owners don't always realize, I think something you have to keep in mind in terms of negotiating. And it's not hard-nosed negotiating. It's just like, this is what this is worth in the condition it's in. It's going to need, and most owners that have had something for 25 years, they don't see the maintenance that needs to be upkept, or they may, but they just haven't really invested that money. Even just from a leasing perspective, a lot of it was handshake agreements. One of the tenants was onboarding tenants. There was no kind of being in the 21st century with this building, online marketing, none of that was going on. So all those things were going to be costs, right? Not that expensive, but rebranding. And I think when you start to present, okay, this is the business plan that I want to employ with this property. I want to take care of it, but I want to add value so we could serve our tenants better. I think owners start to understand in some ways that you're not just driving a hard bargain. Like, this is really the nuts and bolts. This is what it costs, because I'm going to have to put X, Y, and Z dollars into the property to get it to the point where, I can be asking for more rent or increasing my occupancy with higher rent prices. You can't do that if you don't add value. We all know that. So I think and with this, it was an in-person, you're in person. My husband was actually part of that meeting. We were talking about strategy before, but it's just him and the owner. And you got to go there, you got to meet with people. And it's usually done over a lunch and face-to-face and just figuring it out and get it. It's not like most people think, at least my opinion, and maybe it depends on the deal, but a lot of the deals we've gotten and secured when it's gotten to that point, going through a broker is the toughest part, right? You say something to them, they go back to them, and it's like this, it's like playing telephone.
Mm-hmm.
And so if you can get a face-to-face with the owner to knock out the details, to really say what's important to you, what's important to me, let's figure this out together, that's the ideal. And anytime, even on a larger unit, 200 unit that we got was face-to-face, and it was like a 2-hour lunch, just to talk it through. And then they draw it up and that all gets done. But to really get face-to-face with people and say, what's important to you? And it's a win-win. It's not like this, like, how do I, give it all away, but it's got to work for you. It's got to work for them, and come to the middle. So.
Absolutely. All right. So now going back to how did you pay for it? You mentioned that you had investors that you have to be able to give them returns. So how was that structure?
Sure. So, most of our growth, Annette, in our tenure has been raising private money. So what ends up happening is that we work with private lenders, but a lot of these apartment buildings, small or large, are usually with folks that are, private investors and that are equity partners, if you will. And they're in essence like limited partners in the company. And so we had already experienced with a few other funds, if you will, raising money. And that's really your down payment money. That's your down payment, so to speak.
Mm-hmm.
Your down payment, as well as maybe even some construction, depending on how you can structure the deal. And then you're getting a traditional mortgage of, like we all know of with a bank. We have traditional funding. But that 25%, which it was on this project, that's, you have to raise that. It was about $1 million. So we, at that point, had a track record. We had already raised money for our other deals, and, pretty much presented it to our investors and saying, hey, this is what the project is. This is what we're going to be doing. And these are the projected returns. And it's, a traditional syndication, so to speak, where you're pooling money together, and there's a general partner or limited partner structure where you're running the project. You're the day-to-day operator, if you will, us and a couple of folks. And then you have limited partners who are actually the money behind being able to get to the closing table. So that's how we were able to do it. We raised about $1 million. I want to say it was about 14 different investors. And, most of our investors and most people who raise money in these types of projects, you're raising anywhere between, like, say, 50,000 to maybe a few hundred thousand from folks. And these are people that are not multi-millionaires. These are folks like you and I, and that are, either have self-directed IRAs or looking to deploy. They have some savings, or they're an accredited investor. So we work with both sophisticated and accredited investors. But I say that because as folks want to build their own business and they have a track record, don't think it's just like these multi-millionaires. They're not going to give you a lot of money anyway. Quite honestly, if they're a multi-millionaire, they're going to start you at a 50,000 anyway, whether they have 50,000 to invest or they have lots of them. They're not going to give you all their money, and they don't know you, and they haven't closed a deal with you. They're just not. I mean, just like you and I wouldn't do that, nor would you. So I say that as just a quick lesson for folks listening that may want to raise money and work with private money. Just start building relationships with them. And that's really how we were able to present this project to others. And then I think we got some other newer investors. Something else I'd recommend is how we were able to find more people is to start just adding education. Just be an educator out there, whether it's through a YouTube channel, podcast, be a thought leader, share, give your knowledge.
So
comes back.
At what point in your career, how many units did you have when you started raising money for other for your projects?
I would say it was 2000, and it was right after the crash. Beyond our family, I always like to say, because I feel like that's a little, not you're cheating, not because you treat them as investors, but family's a little different than people that are not related to you, right? I always say, because it's the trust level, and just it was probably about 5 years into our investing kind of career, and I'd say we had about 40 units.
Mm-hmm. So you already had a track record and you felt comfortable. And what type of project was the first time that you raised? Like, were you doing it for small multis?
Small multi. It was a small multi. It was a duplex, And no, it was two single family homes that they sold together, but it was actually
Mhm.
two single family, two bedrooms, two bedroom, 2-1 and a 2-1. And it was a gentleman I went to graduate school with, and I met him over coffee about something else. And we started talking. And at that point we kind of deployed, the friends and family, our money was invested. It was just, we were at a pretty much at a stagnation. So we knew in order to grow, we had to get creative, and people get creative in different ways. But our strategy was to say, okay, how can we do this with others? And then with that particular deal, it was $50,000 down payment, very different deal, very,
Mhm.
small. And I always recommend to people, partner with people in small deals. Partnership doesn't have to start on a big deal, especially if you don't have that experience. Start on a small deal. He put up 50,000. We became partners. He had an active role in the company. He did some things, but we were the feet on the street. We pulled the contractors in. There's a classic Burr
Mhm.
strategy where we need to renovate. It was dilapidated, renovated it and everything, and then got tenants in and refinanced it. But he's still an investor with us, that gentleman,
That's
10
awesome.
10 years later. So because, it was one of those successful projects, we were able to pull the money out, pull his 50 out and do it again and again and
And
again.
again, absolutely. All right. So going back to the 49 units we
Yeah.
were talking about, what is your exit strategy for that one?
Yeah. So, it's interesting because most people, as we've kind of grown into the syndication world, most people think like long-term investing, buy and hold, I'll have it forever. But a lot of these syndications and a lot of these projects, a lot of these funds are more structured. A lot of them have like a 5 to 7 year time frame
Mhm.
where you're really trying to add the value, increase the value, increase the revenue, implement your business plan, and then be able to either refinance, get your investors' money back, or even some of their money back and keep the asset, or sell the asset
Mhm.
and do it, do it over and over again. So a lot of these projects, especially the 18 unit we did sell, and it was within 4 years.
Mhm.
And it was just the right timing, it was the right buyer, that kind of thing. But the 49 unit we still hold. We're in the process with that particular building, where I guess we're about year 5. We're in the process of refinancing, or we want to refinance, and we've gotten the building, we've increased the value, but we have a raw piece of land that's connected to our site. So we're actually working with a partner to add units, add another building that raw land. So we're in a different strategy, whereas we're not looking to sell anytime soon. And we've had people we're actually just going to create more value, utilize our space and utilize the raw land, and then refinance the whole thing, and then probably hold it for a number of more, probably at least 5 or 6 years. I would like that to be one of those ones we have forever, but we have a hold in, and we're part owner, right? We don't own the whole thing, but it's one of those really great assets that I wouldn't want to sell, to be honest with you. But yeah, the investors, some of them want to get out. So when you refinance, you could start buying investors out, redeploying their money. It all depends on what your operating agreement says. But yeah, a lot of these larger projects, a lot of the folks want to get their money working. But if you give their money back, they want their money to be working for them. So it always depends on, again, what your business plan is and how you're operating it. But at least with that building, we took the side of not selling, but actually just building and adding more value to it.
Right. And right now is kind of a weird time to try to refinance, right? Because banks are tied. They don't want to give you money on refinances. So it's a good option to just keep adding value to
Yeah,
that property.
absolutely.
So when you started with this 49 unit, was it the time frame 5 years, 10 years? Did you have to extend this exit?
Oh, okay, gotcha. Yeah, when we first projected, we presented this to investors, it was always like 5 to 7 years. So as we've kind of re-strategized, because at the time, even at that moment, we didn't know we were going to be building and, all those sort of
Mhm.
things, um, and refinancing. So yeah, you keep communicating to your investors and say, this is what we're doing. And if people want to be bought out, or those sort of approaches, or sell their shares, all that's laid out in the operating agreement. The time frame you're giving people is really like not, I want to say a loose time frame by any means. It's not like this made up time frame, but it's like a projection. So it's
Mhm.
not by any means in the operating agreement like, hey, if we don't sell within 5 to 7 years, X, Y, and Z happens. It's not that formal, but it's just a typical approach with these projects. But when the business plan shifts and there's more of an opportunity to add more value, you can kind of shift that a bit and then communicate to your investors what the plan is. And then, as long as it's within the operating agreement, so you always go back to the operating agreement. You always go back to, okay, what did we all sign? And some investors, in all the years we've been doing this, we had one investor who said they wanted a refund. We're like, okay, first off, this is not a refund, right? So you didn't, and so you have to educate people too. I think that's a big part of this. If you're not working with someone who isn't an accredited investor who's savvy, they don't know. So they don't know what they're signing half the time. You got to explain this stuff to folks. And I just am a big fan of that because it's part education, right? Mm-hmm. And all those sort of things. So, but we were able to work with this one particular person who really needed their money back, and legally and from an operating agreement, it was in the project. We didn't need to do anything beyond, hey, this is what we agreed to, but we worked with them, and we had another investor who ended up buying their shares. So we kind of did the right thing to support this person. But I just say the key there is you have to know everything written in terms of timeframes, and there's a plan, and then there's like what's in writing and what's in the operating agreement. So
absolutely.
Productivity hack.
All right. So now I would love for you to share with us a productivity hack that has taken you to the next level in your business.
Sure. So one of our lifeline and our lifeblood is working with investors, working with folks who see us in different places and want to be part of our projects. And we were doing a lot of that manually. Someone would say, hey, I want to learn more about you, and so you start to get a little overwhelmed with emails, or it just gets overwhelming. So we had worked with one of our investors who's really savvy with Podio, and we created an automated process through Podio that you can pretty much have that email chain happen without you having to. And I know this seems so obvious, and so many people do these kinds of things, but the time we did it, which was about 2 years ago, I was not automating anything, So that's been great, where people will come in, fill out on a form, they and then by the time they get on the phone, with typically my husband's usually that first point of contact with just connecting with people. What are your goals? We know what their investment goals are. We know what they're looking to get out of it. I'm a big fan of automating those things that can be automated. And then obviously conversations and getting to know someone and building relationships. You can't automate that. You have to be on the phone. You have to connect. We want to, right? I want to, anyone we invest with us, we want to be able to talk to, make sure it's a win-win, right? Someone's like, I got my last $25,000 and I want to invest it with you.
Yeah,
don't give it to us, please. Don't, save that money.
On that money.
I don't want that money. I don't want that on my conscience. I want you to have your own. I want you to have money to have a safe net. So my point is saying that you wouldn't know that necessarily from a survey form. You know these things by building the relationship, and who knows how you could both support each other. So that's been a great hack, is to really cut down on like the stuff we were doing back and forth. When can you talk to? It's like crazy, Whereas now it's an automated process. So
awesome. All right.
Expert tips.
So now we come to the part of the show where you're going to give me your 3 expert tips. And Liz is going to talk about building your investor base. So 3 expert tips on building your investor base.
So the first most important thing is to build a track record as quickly as you can. And you may have experience with investing in various projects. Well, start to document that stuff. What was the time frame? What did you do? How much money was spent? What returns were there? Even if it was your own return, right? And that's okay. So you got to start documenting that stuff, because any investor wants to know their biggest question mark: can I trust this person? Will I get my money back? And ultimately, will they protect my money? They want returns, but really when it comes down to it, somebody wants to make sure they're going to get the money back.
Right. So it's more important to not lose the money than to make money.
I think both are important, but if you had to prioritize it, protecting money and then being able to make money for that person, they're both important. I don't mean to say the other thing's not important, but I think the protection of their asset, the protection of that nut is always the forefront. And then obviously, okay, what kind of returns? People care about returns, obviously. And there's so many people out there that people could work with in terms of, syndications, this and that. But the relationship's important. Are these people good people? Are they going to communicate with me? Do they have a communication plan? So when you're at, the first tip is definitely build yourself a track record. I want you to give another tip around that. If you want to start getting into apartment buildings, you don't have to be the operator of an apartment building. Start working with a team who's doing this. There's a lot of great people out there. I know a lot of them who are doing this. They're operators. They need things. They need help. They need either money. If they're getting into larger projects, they certainly need money. They may need other things. So you can start being part of that team, and that's starting to build your track record. You don't have to say, I was the general partner of that project, but maybe you get a little slice, and then you can start building that track record. And it's not about the percentage, but it's about the experience. Mm-hmm. And that's what investors really want to know. They don't want to know that you've read a lot of books. They don't care that you've listened to a lot of podcasts. I mean, I love podcasts. I run one, obviously. What they really want to know is, what have you closed? What have you done? So you have to speak to that. And if you don't have it, go find it. Go add value to someone else's team. So that's number one. Number two, I'd say communication is everything with investors. Whether you under communicate, whether you over communicate, people want to be communicated to. They want to know how their money is doing, not when they have to ask for it. Okay, proactively. We send out a monthly newsletter. During COVID, during like the heightened COVID, I mean, I know we're still in the new normal now. We were sending 2 communications out a month. 2, not 1, 2, every other week to update our investors. Because whatever was on everyone's mind is, how's my asset doing? We're hearing that there's strikes going on. People are being told not to pay their rent, right? Some of the areas that we own property, tenants were being told not to pay the rent. So obviously our investors in those areas were like scratching their head, like, what's going on here? So I would always say over communicate. Have a communication plan that you communicate to people. I don't care if you have 1 investor or 200 investors. You need a communication plan, and it needs to be consistent. And you need to think, how do I overserve these folks? How do I add value to their lives? Not just the money, but their lives. I think that's a big question that we've asked, and we're continually trying to figure out. So that's the second tip. Third tip would be, start small. I know there's a lot of podcasts. There's a lot of people that say, go buy a 100-unit apartment building. I think we took an especially long time, me and my husband, I'd say, but we learned a lot along the way. We had some bumps. And I'm very proud of our experience. I'm proud of our path. Had we focused, we would have maybe been a little further along, as we've grown. But my point in saying is to start small, is to learn what you need to learn. And you can only learn that on a smaller deal. Unless you're part of a team and you can go take down a 100-unit apartment building, good for you. But I'm a big fan of starting small and just, losing 10,000 is very different than losing 100,000 or $1 million. And as you get bigger, the zeros are on that, dollar amount. So the chance of losing more is higher, right? I mean, we've lost money small and big. And I could tell you that I wouldn't have been able to deal with the larger stuff if I hadn't gotten experience on the smaller stuff. That's just been me. That's my experience. But I don't know. I think it's a great recommendation for people. Get your feet wet, get experience, own it, know it, and then expand. So that's the third one.
I love that, because that's the same way that I feel. I feel like if you start small, you're going to learn gradually, and the mistakes are not going to be as big as, if you start from a big unit. I mean, if you can start with big, even better. But definitely, starting small for me is the way.
Yeah.
Thank you so much, Liz. This was amazing. I think my audience is going to be learning so much from this episode. So tell us, where can people find you online?
Sure. So a couple places, obviously the Real Estate Investor. That's where Anette and I connected, and it's been wonderful. We have also, weekly podcast comes out on Fridays, and we interview only great women that are doing this business and in the trenches, as we say. We also have a community that we're building, so you can find us on Facebook. Just type in the Real Estate Investor community. It's a free Facebook group where people are just supporting each other, and you're able to promote yourself. You're able to share what's coming up for you, whatever is happening. But yeah, the realestateinvestor.com is probably the best way. And we're on Instagram and in Facebook. So those are the 2 places. And also YouTube. We're on YouTube. We're in YouTube as well. We're trying to get more active there too.
Amazing. Thank you so much. This was amazing. And everybody, make sure that you listen to the Real Estate Investor podcast. They have amazing episodes. And I share the goal of promoting more women in real estate. I try to get a lot of women in my podcast so that they can share and we can watch each other grow and see other women as an example as well, because sometimes it is a little bit of a men's world. And it's so nice and refreshing to see other women doing it.
Yeah. Well, thank you so much for having me on your show.
This was Real Estate Deal Closers with Anette Talie, brought to you by Talie Investments. We hope that you enjoyed this episode. Our goal is to provide amazing value on your real estate journey. Connect online at www.talieinvestments.com, where you can find this episode and more. Did you like this episode? Subscribe, like, and share.